Good afternoon, everybody. Welcome to today's webinar. This is Future Planning for You and Your Business, Financial Considerations to Set You and Your Business Up for Success. This is part of our ongoing financial empowerment series for small businesses. My name is Mahala Nyberg, and I'm the Small Business Services Coordinator at ANCA. And I'm also joined by Lauren Richard, who is our Small Business Program Director, and she'll be facilitating today's panel. I'm going to hand it over to Lauren. She's going to do a little introduction to ANCA and who we are for anyone unfamiliar, and then she will introduce our panelists as well.
Thanks, Mahala. All right, so just want to tell you a little bit about ANCA, which is a nonprofit, non-governmental economic development organization since 1955. We have 23 staff based in Saranac Lake and across the region. We serve the 14 northernmost counties of New York State. These are the counties that we serve here on the screen. We envision a new economy that works for all. We want to build prosperity across northern New York, and we want to create and sustain wealth and value in local communities. Our work is funded in many different ways, including federal, state, and local grants, philanthropic dollars, event fees, donations, and memberships to keep us working for you. Your participation and support here today are greatly appreciated. You can learn more about that at adirondack.org under support. We have a bunch of other upcoming events and programs. We have a couple more of these sessions after this and in the financial empowerment series. We also have one more session of our kind of initial test run of our virtual entrepreneur roundtable. And we also have Adirondack Buyer Days coming up at the end of March. We also have the second vendor webinar for that this evening, which is open to the public, which is called Build a Better Booth, and it's hosted by the Small Business Development Center in partnership with us. And it's all about how to make a booth or a table for sales type events that are magnetic to buyers and shoppers. You can always learn more about our events that are coming up at adirondack.org/events. This is our contact information for future. We'll also put that in the chat at the end. So if you have any questions or you need follow-ups from us. And we have all kinds of other small business work that we do, including the business transitions work, and that is also on our website. All right, so with that, we will dive into our panelist intros, and I'd like to welcome, we have 3 panelists today, and I'm really excited that we have them here to share their expertise with us. So I'm going to start here with Russ Kenyon, who is the Executive Director of the North Country Workforce Development Board. Russ is a motivated business and economic development professional with a passion for improving and empowering organizations, lives, and communities. With extensive private and public service experience, he has made a significant, measurable impact through 25 years of leadership and organization management. Thanks for being with us today, Russ.
Thank you.
Next is Kim Mannion, who works at ANCA as well and has 2 hats that she wears here. But Kim has degrees in finance and human resources. She's worked in various corporate positions and lived in many places, including Egypt. Since her return to the region, Kim has pursued her passion for small business and small business development. She owned and operated Maui North Ski Bike and Board Company and worked at the Small Business Development Center. Working with small business owners so they can not only survive but thrive is at the heart of Kim's work passion. Thanks for joining us, Kim. Next, we have Mike Rosler, who was with us at another session along with Kim as well. And we're excited to welcome back. Michael is a registered representative and insurance agent with New York Life. He finds that helping clients understand their options and achieve their goals are what makes his job so rewarding. He believes every client is unique and works with them together to develop a personalized approach that meets today's needs and tomorrow's as well, which is exactly why he is here for our future planning session. So we're going to dive into some questions. We have some prepared questions for our panelists today that we're going to go through. We also have some room for Q&A at the end, but if anybody from our audience has a question that is just burning and can't wait till the end, that's okay too. Feel free to come off mute and jump in or pop your question in the chat. So we're going to start here today with this question. When should a small business owner realistically start thinking about an eventual exit or transition? We're going to talk a little bit later about the next steps to take. So this is just kind of, when should people start? Who wants to go first? Let's see. Kim, do you want to go first?
Sure. You really can't start too early. Understanding the process, understanding kind of how your business gets valued, getting your financials in order. That can't really start too early, but at a minimum, we say it's 3 to 5 years to kind of execute a business transition in a way that you want to do it. So the kind of the universal, like you can't start too early, but definitely 3 to 5 years is, and I had a transition really recently that took 4 years. And she said to me afterwards, she's like, Kim, I never would have thought it would taken this long. But she said, the fact that you told me it was going to take this long helped me like bear the process of the fact that it took that long. So it takes a while.
Thanks, Kim. Russ, do you want to go next?
Yeah, I would agree with Kim. I mean, my thought was as soon as possible. I think, building that into your business model from the beginning and thinking about, where you want to exit is a really wise strategy. Okay. But as soon as you can is the next best answer.
Yeah, we're definitely going to get into that a little bit. Like, what if you already are kind of like feeling like you might be past that point? Don't panic. We're going to talk about that a little bit today too. Mike, how about you? When should a small business owner realistically start thinking about an eventual exit transition?
Obviously, earlier the better. I think when you start to put together your business plan, having that as one of the things you think about of where you see your business going and what is the process by which you would exit it, or at least figure out a way for you to derive value from it over some period of time. Hopefully, most people think about, hey, I'm doing this for my retirement, and starting to think about that as soon as you can is really helpful to start to put in place the things that maybe you wouldn't have time for once you get into the daily grind of trying to grow that business. Kind of putting that sort of into your plan at the beginning can be really helpful to at least let you know, hey, I need to be thinking about some of these things as I'm going along.
Great, thank you. What are some key ways that a business owner can prepare their business finances, since this is a financial empowerment webinar, for an ownership transition? Like, for example, are there certain records that people should be keeping or certain metrics people should be paying attention to ahead of time in order to set themselves up for success with a business transition? Mike, I'll start with you this time.
Yeah, I'd say one of the hardest things for someone who's early on in an entrepreneurial career is separating the personal from the business, and making sure you have a clear delineation between those two things can be really important. It can be hard because some days you're like, listen, I got to pull from this account to go here, and you're just trying to get the business off the ground, but really trying to have a clear separation. There's so many software tools that are out there nowadays that will allow you to keep track of your business finances, whether it's QuickBooks or something similar. That's a great way to at least know, hey, here's where my business is. And, for an early business, one of the things to think about would be from a cash flow perspective. It's easy, not so you don't have to worry so much about all the accounting pieces that might go into it. Just try to understand, like, hey, am I making money at the end of the day that is actually going into the bank? Then that's a pretty good sign of success, and especially early on, that's going to be really tough. But that's one of the, kind of foreshadowing where we would go. But that idea of understanding where your cash flow is a really, really important metric, not only for yourself, but obviously from the people that might be involved from the outside, whether it's your bank or other investors or other lenders. But that's really the most critical thing to really think about, particularly early on in your business.
Great, thank you. Kim, key records to be paying attention to.
Yeah, I would agree on the under separating what you're running through at your discretion, those personal expenses, and not just understanding them, but documenting them. So having the proper backup documentation to show that this is actually a personal expense that I'm running through at my discretion. Um, the other thing would be really understanding your different lines of business. And this is kind of true whether you're getting ready for a transition or not, but understanding your most profitable lines of business so that you can grow those lines of business to be a larger portion of your revenue to the extent that you can. And then I would definitely say close each month, because having monthly financials, like most people have annual financials, but particularly businesses that have kind of a seasonal nature to them, understanding that seasonality and closing each month is, in my opinion, really important.
Great. Yeah, thank you. Russ.
Yeah, I agree with Mike and Kim. I think anything that shows the value that your business creates is really critical. As a former lender, I think it's important to assume that whoever you're selling your business to is going to have to borrow money to purchase your business. It's not always the case, but I think it's safe to think along those lines and to assume that they're probably going to have to be pursuing financing at some point, and you're going to have to, along with the potential buyer, present your financials to a lender in a compelling way that a lender is going to feel comfortable with that transition and with the value that business is creating. Especially as Mike mentioned, cash flow is often an undervalued metric. A lot of people look at their net profit, and lenders are going to look beyond that to say, well, what's your actual cash flow look like? What are your cash expenses that are coming in and out? Are you going to actually have the cash that you need to make payments and to be able to support your business to make sure that it continues to be fluid? So again, just anything that shows the value that your business creates, and you really want to amp that up the last 2 to 3 years, because that's the time frame that a lender is going to be looking at your financials to see what that value is.
Right, great. Valuation is a big piece of all of this, and you're all kind of weaving it into your answers, which is really great because it's something that we need to talk about. So, and is it going to provide a living for that future owner? Great. So, thank you. Let's see, what's next? How can a small business owner prepare their personal finances for their eventual exit and retirement? And some of you spoke to this a little bit already, so feel free to pass if you need to. Kim, let's start with you this time.
So really understanding what you need in retirement. What kind of cash flow do you need? How long does it have to last? Do you have other sources of income? Um, because all of those kind of line up to determine kind of, like, I have folks who can't retire yet because their business isn't worth what they need it to be worth in order to retire. And I think there's another question down the line, but like really understanding what that is and what do you need to do to your business to get there, I think is pretty important.
Thank you. Mike.
Ties back to the earlier question, just trying to make sure you understand that separation between the personal and the business. And I try to think about it from a risk management standpoint. And again, as you go into that business planning and try to think like where do I and my family sort of hive off the business from what impacts us personally and from a family perspective, and are you making sure that you sort of protected from that standpoint before you take on the business risk that, especially as a small business, you're going to be asked a lot of times to guarantee things personally and put things on the line that might be personal, and really trying to understand the impact that that could have on your personal life. And then really, what does that mean from a risk management standpoint for you and your family? And are you starting thinking about that early on to make sure that, one, they're separate, and two, that you've protected what's really important to you, in addition to your business and on a personal level, and making sure there's clear separation early on in that process, because it's easy for it to get messy as you go along.
Yeah, definitely. Thanks, Mike. Russ.
Oh.
Yeah, along the same lines, as what Kim sort of said too, are you going to be dependent on a cash sale, or can you accept payments? Are you looking for a lump sum at the end? Is that critical for you, or is that something that you can be flexible around? because and we'll talk about seller financing later, but that's going to be a potential impact on your tax liabilities and potentially your tax situation one way or the other. So it's important to have a good and clear understanding of how either scenario might affect you and what your tax professional is advising you on the best approach for your particular situation. And also, as Mike said, what personal assets are encumbered along with the business or could be impacted by the sale, and what's your plan to resolve those things. If your business is backed by a mortgage on your personal home, how are you going to resolve that, with the seller and into the deal to resolve those types of things that we're going to be looking at as a lender in the future.
Yes. All right. So owning and running and building and caring for a business, oftentimes for a long time, is a huge, huge investment of your life. And we recognize that this can be a very emotional moment too in people's lives. So we wanted to talk a little bit about how can having a clear transition plan reduce stress and emotional strain for long-time owners and their families, and even financial worries too. Ross, do you want to take that one first? Oh, you're muted.
It's really important, I think, for the stakeholders around you, your family, your business partners, customers, to have clear expectations. I think it's important to set expectations and give people, maybe some different even scenarios. If you're not entirely certain which direction you want to go, maybe you have a couple of contingency ideas that if your preferred transition plan doesn't pan out, if you can't do a full cash sale, maybe if that's what you're hoping, what are maybe some other potential pathways that a sale could take. I think being clear, with again, your stakeholders about what you think the impacts of that business transition could be, whether you have a family member that's interested in the business going forward. We see sometimes, every family dynamic is a little bit different, and some families are more sensitive about these things than others, but you don't want to blindside your family, I think. If, those particular, one of your children might be more involved in the business than another, I think it's important to have those difficult conversations, if they are difficult early on, so that people don't get blindsided and they know how to set their own expectations.
Yeah, thanks, Russ. Mike, you want to take that one next?
Yeah, I'd certainly echo what Russ said. Having a plan makes it a lot easier to communicate and understand it for yourself and for others. And it really will, to that communication standpoint, it really helps reduce that feeling of like, I don't know what's going to happen. And then other people coming to you asking you what is going to happen. And then you're like, well, I'm not sure. And when you have a plan that's written down, you can really say like, and obviously plans change, but if you have something, again, if you kind of started off with like, hey, here's the goal, and that could change, but as long as you have something that like, hey, I'm working from this plan, I'm working from towards this goal, I'm working, with these parameters, and you adjust that on an annual basis, let's say, and then you can start to feel like, okay, well, actually, you know what? We've been more successful than we thought. We maybe need to think a little bit more differently about what this is going to be. Maybe because that business, that's like like you're raising a child. Like it's going to be part of you, and it's going to be very hard to separate your personal like emotional connection to it to how someone else might view it. And that's, we'll get into it later, but that can be a real challenge in trying separating yourself from the value of the business, because you put so much of yourself and your personal value into it. So developing that plan can really help reduce and like understand like, oh, hey, it's not personal, but this is how this business should look. This is how it will transition. This is how it could be valued. And having that, at least a piece of paper that tells you, okay, we've thought about it, can really reduce that stress level.
Great. Thanks, Mike. Kim.
I know we said we'll talk about seller financing down the line, and we certainly will. I think it's important now. 85% of small businesses are sold with some component of owner financing. So understanding that kind of going in, and it's in part, we'll talk about goodwill, and goodwill is the value of the business itself, the cash flow, the customers, all of that good stuff. And so chances are an owner is going to have to hold paper for that piece. And so valuing the business in a way that the new owner can afford the debt service for not just the goodwill, but everything, the inventory, furniture, fixtures, and equipment, like valuing the business in a way that works not just for the seller, but also for the buyer. Because that way you go in knowing that you feel good about it. You feel good about what you're going to get. You feel good about the new owner. You feel you're setting them up for success. So unless something goes really south, that hopefully they can pay that loan off to you. Um, so I think that really kind of helps because one of the number one reasons why small businesses don't sell is because they're overvalued. And so, you know, the numbers don't work and you're not going to get conventional financing or it just doesn't work. And then kind of the last thing, and this is, I've worked on a number of different sales with different priorities, is understanding your priorities. For some sellers, their priorities are, cold hard cash and cold hard cash at the close. For other sellers, it's their employees and knowing that their employees are going to be really well taken care of. Or maybe it's their customers and they want their customers to be really well taken care of and they don't care as much about the dollars, but kind of going in and understanding that, I think the different pieces help reduce the stress. And there is no question it is stressful. And there are going to be bumps in the road and um, buyers are going to tear apart your baby, right? This is a business that you have built over the years, and a buyer is going to tear it apart. The buyer wants to buy it for as little as possible, and so they're going to find ways to try to negotiate to a lower amount. Um, and then, so it is without question a roller coaster, and kind of, I think, understanding that going in just kind of helps you. And along that line, understanding we talked about how much you need at the close, so that would be the money that somebody is going to get from sources other than you as the seller, be it the bank of mom and dad, an economic development organization, a traditional bank. Um, Knowing how much they were going to get from other sources that you'll have in your pocket the day you close, in addition to the amount that you're going to hold, and really kind of having understood those different elements helps you kind of prepare, whether it's mentally or intellectually or whatever, for when you get into those situations.
Could I add something?
Yeah, absolutely.
Yeah, those are great thoughts, Kim. And I was just thinking about the situations that we've come across together that folks start having very complicated feelings during the sale that they haven't really processed prior to those
Yeah.
situations where a buyer may have different ideas for what they want to do that come out kind of during the sale process, and that creates sometimes or family feelings, and thinking those things through ahead of time gives you time to process some of those complicated feelings prior to being at the table with the buyer, and all of a sudden you're like, you're feeling frustration or you're feeling possessive about a certain piece of the business that might change. Those are natural feelings, and I think a plan gives you a chance to process some of that ahead of time.
Yeah. I'm sure you can't anticipate everything, but yeah,
Yeah.
as much as possible. Definitely. Great. Thanks to all of you. All right. So, what are some financial factors that can make or break a business transition or owner's retirement? Like, if you can give us like a couple of examples or things that you have seen people kind of miss the mark on, or things you wish people would think about ahead of time or prepare for ahead of time or something like that. Let's see. Mike, do you want to take this one first?
Yeah, so first of all, it's funny how many things are sort of a consistent, thread through all these different questions, but, having a sense of where you are personally financially and is really important to understand, okay, what do I need from this business? And it's like Kim mentioned, like, hey, what was your plan for it? And is this going to achieve the goals you had personally for your retirement? And having that plan that you're evaluating on an annual basis to say, like, okay, I'm on track to where I want it to be, or I'm ahead of plan, or I'm behind on plan. And do I need to do something a little bit different? Do I need to plan separately, personally, than what I thought the business was going to do? And the fact is, when you get to to sort of that point where you're looking to transition the business, the other side of the table is not going to look at it the way that you do. They're not going to they're not going to care as much. They are not going to be as impressed by how many hours you put into it. It's not going to probably matter, particularly if they're more of a financial buyer, just and they're going to, look at the the documents and the accounting, and they're going to say, well, you generate X amount of cash flow, and that's all they may care about. And it may not matter the relationships you've built in the community and the employees that you've had for 25 years. Um, and so having that separation of where you are personally, so that way you have comfort from where you're at and what you need the business to do, and have you been on track with that? And like, it's not what you don't want to be is at the end of 20, 25 years, and you thought the business was going to be, 90% of your retirement plan, and suddenly it's going to be 20%. You don't want to be surprised by that at that point, because at that point, there's very little that anyone can do to change those factors. And, I keep harping on the planning idea, but having that, annual at least look at where you're at and and how you're tracking towards where you want to be is going to be really important to be able to get to that transition point and be like, okay, I know I'm at this point and I know where I'm at and I know what it's going to do and I know what I need it to do and not do. And that way it's not a surprise and you're not then trying to scramble and figure out like, okay, well, wait, do I need to go work now that I'm so like that does happen, right? And it really is a question of, and it's so easy to just get caught up in the day to day. And I'm like, hey, I just try to get through today and into tomorrow, but those future tomorrows come really quick. And just having that thought process, saying, how am I tracking is going to be really important when you want to then go transition that business.
Thanks, Mike. Kim, financial factors that can make or break.
So I think a lot of small business owners forget that the buyer is going to have debt service. So the business may be making 50 or 60,000 for the owner, but the new owner is going to have 100,000 in debt payable over X number of years, and it's $3,000, $4,000 a month. So that nets virtually nothing to the buyer. And I think a lot of small business owners think, wow, I'm making a decent living doing this. Again, just forgetting that aspect and just kind of have to bear that in mind. Um, and then it kind of all is interrelated, is overvaluing the business because then it's unbankable and the cash flow doesn't work um, and inevitably. So I had a sale a long time ago where somebody came along. It was a Wall Street guy who had a son who was graduating from college and basically wanted to buy a job for his son, and so was willing to overpay for the business. And then it fell apart. But then the buyer had these unrealistic expectations because they did have a unicorn who was coming along and willing to pay that. And so it's just overvaluing can is not a good thing, bottom line. And I think we'll talk about sellers' discretionary earnings at some point in here. Sellers' discretionary earnings being the total cash value that a business is generating for an owner, inclusive of all of those expenses that an owner is running through the business at their discretion. So things like life insurance, cell phones, automobile, sometimes meals and entertainment. If I didn't say health insurance, health insurance. And those are all legit business expenses, but they are not operational most often. And so differentiating the operational expenses from the seller's discretionary expenses is a big part of valuation. And so understanding those is important.
Great. Thanks, Kim. These are all things that we can help with as well, which we'll talk a little bit after. But yeah, thank you. Ross, how about you?
It's hard to add to all those great points. The two things I think of is, Kim makes a lot of really good points about the seller financing piece. And again, if you've been in business for 25 years, you may have paid off most of your debt. And so therefore you don't have a lot of debt service, but the new owner will. So that's an excellent point to make. One of the things that we've also seen is, there are folks that don't know their business very well. They just, at the end of the year, well, I made 60 grand, but they don't really know exactly how they made that 60 grand. I mean, they have maybe an idea, but they've thrown all their receipts in the shoebox and it all just comes together at the end of the year and they have cash in their checking account and they feel good about it. But when as a lender, I'm looking at, where are your profit centers? Where are you really generating money and generating cash? Are those fairly safe profit centers? Are they at risk? Are they going to continue for the future? We've had situations where somebody was selling their business because there was a huge change in their industry that was coming and they wanted to get out before it happened. And so, sometimes those things come out in the process of looking at, how secure are your revenue streams and is your profit real? So those are things that I think it's important to know your business and know really how much you're making on specific, lines of business, that you can communicate that well, that you can show that clearly. We had a business that was for sale and the guy was able to pull up on his phone how much money he was making that day and on what, and exactly where he was profitable on particular items. I mean, it was really, really amazing to see. And that's very compelling, not only for a buyer, but for a lender um, to work with.
Yeah, that's great. We need to have a webinar that guy talk where he's the panelist and talks about how he did all of that, because I'm sure that would be useful for folks. Great. Okay, the next question is, are there unique considerations for businesses in rural and seasonal economies when it comes to business valuation and transition planning? And again, we've touched on this a little bit here and there, but if we want to dive in a little bit more. Let's see, Russ, do you want to start with that one?
Sure. Yeah, I could definitely speak to it from a lender perspective, that you got to think about the timing of going into a seasonal business deal. For instance, if your business is primarily in the summer, do you want to purchase a business in January where you're going to have 5 months of cash going out before you start making any money? So as a lender, I have to think about, are we able to delay your payments maybe, or do, interest only for the first 6 months to give you a chance? You can't always control that timing, but it is something to think about, that you don't want to put your buyer in a situation where they're not generating any cash for months, going into a potential, financing situation. And I think you can often work with your lender, especially alternative lenders, to try to figure out if there's a model that can help you during those slower months, or that can anticipate, a start date that makes sense for payments that allows you to cash flow that in the future.
Yeah, definitely. Kim, do you want to go next?
Sure. Rural businesses are tough. Selling any business is tough because identifying a buyer's difficult. A buyer that wants to be in your line of business, who has the down payment that you need, understanding that at a minimum it's going to be 20% down payment in order to get any sort of financing. I can't remember the exact statistics, but it's like 80% of buyers do come from outside the area. So you need to kind of spread the word far and wide. But I would say that's is where you really want to consider employees. And I've certainly worked with plenty of sellers who say, my employees don't have the money, my employees don't have the back of house, my employees, right? But here's the deal, employees understand your business, they know your customers, you trust them, particularly long-term employees. And you can teach them the back of house, or bring in a 5 hour a week bookkeeper or something. And it often, I've had sales where people are like, I don't have an employee that I would consider. And then over time, they're like, wow, well, Bob really, maybe he can do it. And so where it could have happened much more easily, it takes much longer. And yes, you are probably going to have to hold paper for quite a bit. Or maybe it's a situation where they forego some salary in lieu of equity in the business, right? Like getting creative around that if you feel like there's any hope. And not every employee wants to bear the burden of small business ownership. Some people just want a salary and they want to go home. But if you're lucky enough to have somebody and it's a mental hurdle around their ability to do the back of house or the financing piece, there are ways to get creative and overcome that. The seasonal piece we definitely talked about in understanding your working capital. So if you are a seasonal business and you make your bulk of the money in the summer and you have fixed costs that you have to carry through the off months and it's you're negative 5,000, negative 5,000, negative 5,000, what's that total negative? Right? You need 20 grand in the bank to cover those expenses, right? Understanding, and that gets to that, having those monthly financials and really and closing those books on a monthly basis. And it was a problem. Like when I was getting ready to sell Maui, I didn't have those monthly financials. And I was able to go back through and kind of create, they were in QuickBooks, but I hadn't really closed them. So I had to really, my cost of goods sold weren't really in there as they should have been. And so I had to go back and create them. It would have been way easier if I had done it when I, should have.
Now you know, right? Now you can
Yeah.
teach other people. Don't make
Oh,
the
oh
mistake
my
that
gosh,
I made.
that are things that I have learned the hard way, like all of us.
Yeah, great. Thank you. Mike.
I mean, the reality is that your business is only worth what someone else is willing to pay for it, and that can be a cold, hard reality when you get to that point. And in a rural area where there's probably to be likely to be fewer bidders that would be available that might have the finances in place, particularly to be able to step up and say, "Hey, I'm paying you the agreed upon valuation at closing." It's like Kim mentioned that it's much more likely, particularly in a rural area, that you're going to be financing that purchase and you're going to be tied to that business for a long time, even though it's going to be in the hands of somebody else, but they're going to be paying you over a longer period of time than maybe you were hoping for, or at least that's going to be part of the process that you should expect to unfold when you get there. And then from a seasonal perspective, the other thing you're going to be asked, particularly in today's environment, is what's the employee base that for that seasonal business? Like, is the business entirely dependent on you as the labor or your family as the labor? And how is that going to impact potential valuations? Because if I'm coming in, I've got to try and figure out am I stepping in to be the labor as the buyer, or am I going to have to try and figure out how do I add in temporary employees on an annual basis? And that could really impact the valuation thinking for that potential buyer, because they may not be considering themselves the labor force. And that's a very different mentality that you might have had if it's your business and you're the one that's providing the labor in that scenario.
Yeah, that's a great point. If a family member's working there for free or something like that, it can impact that a lot. Yeah. All right. So let's see. What are some common, or let's say one. What's a common financial mistake owners make that reduces the value of their business when it's time to sell or transition? And what might they do instead? Kim, oh, sorry, I did
Yeah,
right when
no,
you're
you're fine.
on. Do you want to go first?
Sure. Running too much stuff through your business undocumented. So evaluation, a seller is going to look at the value of their business through one set of lenses, and they're going to take the seller's discretionary earnings and they're going to back out all these different things so they come up with a really nice number. The buyer is obviously going to use a different lens and they're not going to be willing to recognize some of those discretionary expenses. And then a bank, and you lenders and folks that work with banks, like by and large, the only expenses that a bank will let in terms of valuation, the add backs, as they're called, are salary and health insurance. And they very often won't let any of the other, even if they're documented, they still won't let them um, add those back to establish. So really quickly, valuation of goodwill, which is that non-tangible piece for mom and pop Main Street type businesses. These are owner operated businesses with, 5 employees, 10 employees, micro businesses. seller's discretionary earnings is the most used or accurate way to value those businesses. There's a thing called EBITDA, which bigger businesses and blah, blah, blah. You take the seller's discretionary earnings and you have a multiplier that you apply to that. So if your seller's discretionary earnings is 100,000 and your multiplier for your specific type of industry, type of business or industry is at the low end, it's 1.5, and at the high end, it's 2.5. We take that SDE, multiply it by the 1.5 to come up with 150,000 at the lower end, 250,000 at the higher end, right? And so the what gets added back is as I said, the kind of the things that can get added back are insurance, health insurance, life insurance. I ran my Y membership through Maui because it was important that I was fit so that I could, was that a real operational expense? No. So kind of another example of an expense that I ran through my business legitimately, but it was not operational. And what they really say is as you get closer to wanting to sell your business, you need to pay more taxes and you need to stop running those discretionary expenses through your business because lenders will not recognize them. All they will do is they will look at your tax returns, and maybe not even your tax returns, but the bottom line is you need to pay more taxes as you get ready to pay your business to sell your business.
Thank you, Kim. I think you just answered 3 questions in one, so
Oh,
that's
cool.
great. That was a lot of good stuff. Great, thank you. So let's see. Mike, do you want to go next?
Yeah, I think first of all, having great records is going to matter a lot, because people are going to want to pick through, and it's not just going to be, unless it's somebody who's coming to the table with their own cash and they can make their own decision. That's, a very small percentage of transactions that's going to happen, particularly in a North Country rural type area. That it's you need to have, there's going to probably be outside lenders and they're going to be looking at things through a different lens. So having the appropriate records and good records is really, really important. And, I think the biggest thing that I see people run into is they're emotional about it, and it's really hard to take the emotion out of it. But how the hard work you put in to get it to where that business is at the point to be able to say, hey, I did something great and I'm ready to transition this and I want to see the value of my success. You care about that. Unlikely anybody else cares about that. And that can create a lot of issues when you bring that sort of sense of pride, which you should have, but this is a cold analytical transaction, and thinking of it through that kind of lens and taking yourself out of it can reduce some of the major impediments to getting a deal done, because ultimately you're not going to get paid for what you believe it's worth or the hard work you put in. Um, that's not what someone's paying for. They're paying for what you've created and the cash it can generate. And that's sort of the cold hard reality at the end, and trying to keep your personal and self out of that equation can be really important and enable a transaction to at least be approached and valued independently and emotion without the emotion in it. That will allow you to proceed with the transaction. Otherwise, if you put yourself into it, it can really gum up the works.
Yeah, definitely. Russ, what do you think about that?
It's really hard to add to those great points. The only thing that I think I could add is just make sure your taxes are done and up to date for the last few years. We've had situations where that wasn't the case and that created some snafus, but otherwise, great points.
Great, thank you. How is a small business typically valued, and what surprises owners most about that process? And I know, Kim, you've given us some really, really great insight into that valuation process so far. So we have some of that, but I feel like if there's anything that we should add, we can do that now. Um, yeah, go ahead.
Yeah, I would say so. The a business is made up of elements: the goodwill, which again is kind of the cash flow, the fact that you have a going concern of a business. You're going to value your furniture, fixtures, and equipment. You're going to value your inventory. You may have like a really high-end front end. If you're a online retailer, you may have contracts with certain companies to provide certain things that may or may not. And then there's going to be real estate. And I think this gets asked further on. The real estate does not um, get valued with the business. It's just those components. And you're going to have low and high end estimates of those. Um, they're taxed differently. So it's called an asset allocation, and how much you assign to each of those, the goodwill, the FF&E, the inventory, it that is where all of the negotiation comes in. Because on an asset sale, like furniture, fixtures, and equipment is sales taxed. So a buyer is going to want to minimize that amount. Um, for the seller, there are things that are taxed as capital gains versus personal income. And it gets really complicated. And we haven't talked about a team, but you definitely want somebody, an accountant that understands small business sales, because they can help you negotiate and navigate those pieces.
Thank
Like
you.
I had a client once who she was almost to the sale and didn't understand the tax implications of the sale, and it fell apart because what she was going to net didn't work. And so kind of understanding the tax implications. um and I know we're going to talk about it in a second, the role of seller financing. Seller financing is huge. As I said, it's 85% of small business um sales have some component of seller financing. There's risk to seller financing for sure, but the benefits are terrific too. You're making the interest. You're taking payment over time. So rather than taking 100,000 in a single year where it pushes you into a tax bracket that's highly taxed, you take those payments over time. Um, there's another one, but I can't think of it. Sorry.
That's okay. Thanks, Kim. That's great. Mike, you want to talk about that?
Yeah, I think one of the things start early in that process and understand what's the structure of your business. First of all, are you an LLC, sole proprietorship? Are you going to establish an S corp, a C corp? How does that develop over time? And that will impact some of those things, particularly some of the tax considerations and how it'll impact you personally. I would encourage a business owner to think about how their type of business may be valued. Different businesses can be valued differently. The sort of those metrics that Kim mentioned earlier, the sort of that multiple, particularly of what your cash flow, whether you call it EBITDA, earnings before interest, tax, depreciation, amortization. It's really, they're going to try and get to what is the clear cash flow of your business and what's the multiple I'm willing to put on that in order to pay you. And trying to understand where your business, those sort of valuation metrics and how they're utilized within your business. Like if you, let's say you started a software company, the multiples for that kind of business could be dramatically different than your restaurant or your car dealership. And having a clear idea, as you get closer to that exit or transition, so that way you're not surprised at the end, because you may, talked about it, but you don't want to get to the end like, wait, I only get two times this? I thought it was 10 times. And you're like, well, why'd you think 10 times? Like, oh, I don't know. I just thought it was 10 times. Like, well, that's not the way it works. People, and it's similar, I guess, to, how people think about their house, right? It's like, well, I put all this love and care into this house and I think it's worth X. Like, well, the market says it's willing to pay this. And like, why? Do you have a 4 bedroom house or an 8 bedroom house? And there's just different, valuations placed on that. And just having a clear idea of where your business sits and those metrics can really help you understand like what this exit strategy could potentially look like early on. And you can really drive your planning around that clear expectation versus what you think it might be somewhere down the road.
Yeah, definitely. Thanks. Russ.
Yeah, again, it's hard to add to all of that, but the only thought I have is, beauty is in the eye of the beholder, and at the end of the day, whatever metrics you have in mind or other folks give you, it's really what the buyer is willing to pay for the value that they perceive in the business. And sometimes that, I think proper planning and having a good rationale can push back sometimes maybe against a buyer who doesn't have the same number in mind that you do. I think, if you can demonstrate strongly what you're basing your number on and the value to them, that's a good way to counter that or to try to get closer to the number that you think it's worth. But at the end of the day, it's really what the buyer thinks it's worth and what the lender thinks it's worth are important factors that can sometimes lead to disappointment for folks.
Yeah, prepare as well as we can, and then I guess we have to work with kind of what happens.
It
All right.
sounds very much like, hey, prepare to be disappointed. I'm not trying to send that message, but just, I guess, be prepared is I get, kind of scout motto kind of thing, but that will help you along the whole way in a lot of different ways. But having realistic expectations is going to lead to much less disappointment.
Yeah, and I'm not saying like you're right, Mike. Not saying prepare to be disappointed, but again, the more work that you do on your end, the more that you can emphasize that value and adjust what somebody else feels that value is worth to them.
Great. Thank you. I think we're going to skip down to our last question for right now, and then we can kind of see what happens after that. But what steps can someone take in the next 6 to 12 months to strengthen both their business and their personal finances for a future transaction, whether that's in, whenever that transaction might happen? Russ, do you want to take that one first?
Sure. I think one of the things that often is undervalued is documenting your policies and procedures well. If you have sort of informal ways of doing things, it's important maybe to codify those things so that you can provide your policies and procedures upfront to a potential buyer. That's one of the things that I see a lot of businesses don't have in place because they know what they're doing, they know the business, but your buyer doesn't. So, documenting those things and preparing those things for the transition is important.
Yeah, agreed. The things that live in your head or live in sort of the culture of your business, but maybe aren't written down. Yeah, great idea. Kim.
Maybe similar to what Russ said is go on vacation. Because if you can't go on vacation, it means somebody's buying a job, they're not buying a business. And so the business needs to be able to function without you. And whether that's through written policies and procedures or just entrusting more of the operation of the business to your employees. Yeah, it's a pretty big one. And then just take your financial acumen within your business to the next level. Whatever it is, wherever you're at, you can always be better and really understanding your numbers. And that's true whether you're getting ready to sell or just running your business, but really understanding your numbers is important.
Great, thank you. Mike.
Yeah, just to that sort of annual planning thought process would just be, are you asking yourself once a year, if I had to sell tomorrow, what does that mean? Just, in the next 6 to 12 months, ask yourself that question. If I had to exit this tomorrow, what does that mean? And am I where I need to be, or what is my backup plan? Because I can tell you through experience, things do not always go according to plan, and you have to have some thought about what is that going to mean. So have that thought process, have that conversation, and sort of ask yourself some of those hard questions. What happens tomorrow?
Yeah, great point. All right, we're at time, so I want to thank our panelists, our remaining folks, and Mahela as well for your tech support and everything. And thanks to our attendees for joining us. We'll send out the recording in a little bit, and whatever supporting materials are relevant for you, and hope to see you again on one of our other webinars.
Thanks, everybody.
Take care.
Thank you.
Thank you.
Bye.